Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from Ticket-Tacker. We're taking a look at the gold market right away, 1732.70, down $9. We have activated a buy trigger, as you see right off the bat, trading above 1732. 32.10 was the entry point, and so the system went off the bat long a gold contract. The target automatically is 1739. Your protective level is 1732 below, and you can choose 3 of the stops that we recommend. We're going to be trading. We're going to be trading today, as it looks like we have come down to a major level of support. And we have activated a buy trigger from the pivot point 1732. By the way, these are proprietary pivot points that we use. It's one of the components of 4 or 5 different metrics that we use. And the algorithm, which was written in C++ and easy language, is what basically activates the trigger point. And that's what I'm teaching you guys for self-directed traders. And this is part of the methodology that I teach in my trading room, my private trading room. Just to review the stops, the most conservative stop is the close below 1732 using 15-minute bar. Do not use straight stops. The VCPMI does not use straight stops except when it moves into a profit level in your position. Use the 15-minute for aggressive traders. You can wait until the market either completes the target or it comes down and tests the lower level below, which is 1722 to 1720, if you are looking to add multiple positions. As I keep saying here, once again, when the price comes down to the levels below buy 1 and buy 2, ideally in blue, as you can see, the AI is telling us do not sell, do not go short here. Use this to accumulate longs all the way down to buy 1, buy, the weekly and the buy 2 daily, and look for a reversion to unfold, which is the market reverting right back up above what you see right now. Right now, the momentum has been activated. The probability factor of 90% reversion back to the mean of 1739 has been activated. When we're trading at B1, we're looking at a relative implied volatility to the mean of 90.50. The buy 2 level is 95.50% relative implied volatility. And that means that the average price is a 50-50 standard deviation. B1 is a 50-90 standard deviation, 1-to-1 factor. B2 is a 50-95 standard deviation, 2-to-1 factor. So in this simple format that you see here, we're dealing with mathematical probabilities that are identified in blue in color. If you entered your position and you're carrying a profitable trade, begin to trail your position to your entry point with a stop. Trail the stop. If you want to go all the way to the target above, which is 1739. This line, this red line here represents a Fibonacci trend line support, and this helps me to identify the relationship of the algorithm, to all the other conventional indicators. And so, but they are reinforcing the fact that the market is doing exactly what the artificial intelligence suggests the market will do when it gets down here. And of course, the market will only be the one that will confirm or negate that signal. And right now, it's validating that intelligence. So this is what mean reversion trading is, in that what I look for is trading opportunities that are extreme above the average price of the supply and demand for that trading session. In this case, we're looking at a day trading session. So I'm using the daily signals, but we also have posted the weekly signals on the right of the chart, so that we can increase higher the probability factor, the harmonic relationship can be identified, and that's the most optimal signals, you might say, that are produced by the VCPMI. So what are we looking at here? We're looking at a signal that was activated from a buy one level of 1732. And right above it, we're looking at the daily average of 1739 and 1738, which is pretty close harmonically. This is what I mean by identifying a harmonic relationship. When the price adheres almost at par to the weekly and the monthly, and ideally on and on and on and on, that we essentially move into the cycles, the 9-year cycles, the long-term cycles, following the same structure. But identifying the prices at a harmonic alignment is a very strong probability that is serving, you might say, as a magnet in price to attract buyers towards that average price. And then it's going to test to see the kind of supply and demand we trade around there before it identifies the next trend direction. The silver market is activating a buy signal here. You want to be prepared. It's activating a buy signal. A close about 25.75 is confirmation of a buy trigger from the buy to level of 25.75. Once again, what you see here is the trading of the market since the Globex opened, moving up towards the target, activating actually a buy trigger at 6:30 p.m. and reverting again at 7:45, meeting the target above, which is the weekly. It was the weekly target here of 25.85. It completed that target, and we saw supply greater than buyers here, okay, which I want to point out to you, this is during the night, during Globex. So who is going to be buying? Most of us are asleep at this point. And this is when the short sellers, whoever they are, take advantage of the illiquidity of the market. And in silver, because it is a thin market, they manipulate the price based on volume, based on selling more volume, more supply than buyers. That brings the price down into the extreme below the mean. Yet it came down to a low of 25.45, not quite to the weekly low of 25.36, and found buyers at 2:15 a.m. And here's where the AI tells you when you're in blue, especially when you're combining the daily and the weekly levels, when you're in blue, you do not want to sell into this level. You want to look for the price to find the selling pressure, the supply to find buyers that are greater than the supply that is being sold. And in this case, they showed up at 2:30 a.m. and reverted all of this selling pressure back out. They took out all of this supply from 2:30 a.m. all the way to 4:30 a.m. and brought it back up to the target, the weekly target of 25.85. And once again, at 4:45 a.m., we saw another attack on the short side. But if you noticed, the lows were higher lows than before. And when you look at this formation, it looks like it's building some kind of a head and shoulder bottom. Left shoulder, the head, and this is the right shoulder. And if we break through this, the head, let me use some conventional technical analysis here. And if we break through this level, which coincides, by the way, with the 25.75 trigger point, which is really amazing, then you're looking at a head and shoulder breakout from an extremely oversold condition on the daily of 25.75. And if we get up above 25.85, you're kicking in the weekly signal along. And so to me, I think the probabilities from what it looks like is that the market wants to challenge that 25.75 or 85. So we'll keep an eye on this stuff. But a close about 25.75 is going to activate a trigger, a buy trigger point in silver. Yeah, we're looking at the E-mini S&P approaching the sell one target of 39.21. So we'll keep an eye on this market and see how it reacts to these levels up here. Let me share with you. This is the weekly report that we published in Seeking Alpha for the benefit of our marketplace subscribers ahead of time. This was published on Saturday, so they are prepared in my trading room as well as in Seeking Alpha prospectively with this information. And so here we're taking a look at a weekly structure for gold, which includes the filters that we use in the algorithm. And one of the filters is the 9-day moving average, which identifies the trend momentum. And the weekly trend momentum of 1779 is bearish. The price close below identifies it as bearish. The weekly VCPMI of 1738, which is the variable changing price momentum indicator, or the average price of 1738, is bullish. The market closed at 1741.70, so it's coming in with a bullish weekly average price trend momentum. This is the second filter that we use, which is the average price. Now, this is the intelligence that I provide to my traders that subscribe to this information, is that I share the stop or a close below 1738 stop negates this bullishness neutral. And if short take profits at 1722 to 1701. So it gives you a weekly signal protective level that you can use. Also identifying the targets below. So this is telling us today that if the market closes below 1738, that you can get out of the position, or in fact, you know, as I said, this information was prospective, but it gave you already the whole action that we saw today. Pretty much, the low today was 1716 in gold. Oh, I'm sorry. The low that we're looking at 1716 was on the 18th. And we're looking at about 1726. I'm trying to see the low here that we made today. About 1726. 1716 was made on the 18th. So it did not quite come down to that 1722 area. And it gives you two levels. For the week is 1722 to 1701. And it tells you if it closes below 1738 today, that you can go neutral. It's a mixed signal between the nine-day moving average and the VCPMI of 1738. So for the week, 1738 is a critical level that we're looking at. And that coincides with the daily level of 1739. Let's take a look at the action here at these levels as we seem to be trading at the buy one level here. And we're bouncing off this Fibonacci trend line that closing above this line will become support. But right now it's a little bit of resistance trying to get through it. And so it's early enough that I think what it looks like is the path of least resistance is to buy the market. So let's watch it here for a bit. The gold market is looking positive here. We're picking up volatility. We broke through that resistance level. And so 1738.39 coming up. So if you entered the position, depending upon the contracts that you have, you can trail the stop. And you can see the price never really stopped you out, even on the conservative side. We're looking at the expiration of the March contract coming up here at the end of this month, and it's going to be interesting to see how the March contract settles in silver and gold market as we are running into what appears to be a tight situation in the physical market in gold and silver. The market is experiencing very high premiums, and the delivery time is a long time wait, and demand seems to be at record levels. And so I would not be surprised that we're going to see that reflected here in the paper markets anytime soon. So all you guys that are long in the futures, that are frustrated, that whatever it is, be patient. Be patient. It's coming. The gold market will trade when it's ready to go, and you got to be patient with it. It doesn't go when you want it to. And, you know, as you can see on the face of all of this short squeeze publicity in the internet about silver squeeze, Reddit, the silver market came down, you know, a solid $5 off the high since that Reddit crowd entered the market. And unfortunately, it looks like a lot of people got hurt there. Young traders that chase the market, you know, hopefully learned a lesson. Continue to hold the gold. We're beginning to pick up momentum by trading above the Fibonacci trend line and moving towards the pivot point target of 1739. Good buying is coming into the market here. And if we can get through that 1739 and it closes above 1739, then we're looking at 1751, which will pretty much put the market on the plus side, and it could be considered, today could be considered a key reversal day, which is extremely bullish. Let's see how far we can get buyers to move this market up into those levels here today. We're getting some help here on the 10-year note. The rates are coming down here, down about 2.06%, down about 3 points. So it is helping precious metals, and obviously pretty much across the board from taking the pressure of higher interest rates. I think, once again, the fact that the 10-year note has risen, almost doubled actually, in a very short period of time is an indication that all of this stimulus that's coming into the market potentially could be inflationary. And I think the reason why the markets are beginning to anticipate that, particularly the interest rate market, 10-year note, 30-year bond, which are really very sensitive to a rise in interest rates when you're looking at, you know, rates pretty much near zero. And if you factor in inflation, we're negative in real terms. Is that we're dealing with a different landscape than ever before as a consequence of this pandemic that we are still experiencing and trying to come out of it. There is still the risk of another spike in Europe. So there is still risk in regards to the pandemic on a global scale. And so the difference is that the pandemic has disrupted the supply chain. On top of it, and we're beginning to see shortages in the system in different areas, different sectors. Computer chips, plastics, vaccines, gold and silver. So I think the difference is that we're looking at a broken economy that has been under a lockdown, supported by stimulus, government, and has not had the opportunity to spend that money. We've been under a lockdown. So the combination of a compressed level of demand into a broken supply chain with a record level of stimulus is a danger combination for the velocity of money to explode into a highly inflationary spiral. And that's my concern as a trader. That's what I'm looking at. And that really would put tremendous pressure on the Feds to control that by raising interest rates, which will be disastrous for the world economy, disastrous for the U.S. debt. When you think about that, we're running almost a $30 trillion debt factor, and only 1% change in interest rates represents about a $30 billion, 10% of GDP. And in some, depending upon what numbers you look at, it looks like we are running about 10 to 15% potentially of GDP. And so one of the arguments I had with one of my, not arguments, but just discussion about interest rates and the effect of interest rates, that if interest rates do rise, it will explode the trade deficit. It will explode the debt to levels that we have never seen before. And potentially that could be, hyperinflationary. The difference between where we are right now and in the 70s is that, first of all, we didn't have a pandemic. We didn't have a broken supply chain. We were dealing simply with the consequences of Nixon lifting the gold standard in 1971, when the dollar went into this inflationary cycle by becoming the U.S. dollar reserve without any backing, and it became a petrodollar. And the government began to print recklessly endless amount of money. In those days, I remember in 81 or, $200, $300 billion trade deficit was nothing. The debt was literally nothing. But yet gold went up to $800, $850 over $850 an ounce, and interest rates exploded to almost 15% in 1981 simultaneously. to gold increasing in value. So interest rates went up to kill hyperinflation, obviously, to 15% that we saw, because that the only reason why they went up to 15% is to kill whatever inflation or hyperinflation was underneath the system. And it is a perfect example that this is a very, very similar situation to a certain degree with the 70s, except that we're dealing with, I would say, a more rotten core economically with regards to this debt. And this is the danger. This is the poison of this currency that we're talking about as a product, as a unit of currency, that it is now entering a level of hyperinflation. If we do not are able to reduce this tremendous stimulus that is going to come at a cost, not only on a future basis, when you're looking at what it means for the future of our kids, millennials, wow, it keeps getting darker with regards to the purchasing power of your currency, the US dollar. And I think the smart millennials, the young, smart trader, the young, smart investor is beginning to recognize that, which is what this whole Reddit movement is about, is because they're beginning to recognize that we need to be looking at what is real money. What does real money represent? And it doesn't really matter how much savings you have. It doesn't really matter how much profit you're making in the stock market. If the currency collapses to zero, everything will be valued to zero, regardless, on that currency. Before we enter a whole new economic system, before we enter a whole new currency, this system, this currency that is indebted and has lost 98% of its purchasing power against gold in real terms, is at risk, truly, and that goes for all of the currencies that are fiat currencies, are at risk of collapsing to zero. And if you really think about it, that would be a perfect way out, wouldn't it, for our leaders to collapse all of the currencies to zero, therefore wiping out the debt in that currency, creating a whole new system, which is what's going on, as you know, with regards to Bitcoin. This is the reason why virtual currencies have come to existence, is because there is a need for an alternative currency. Not that I am saying that virtual currencies are currencies, they're virtual assets that are traded like a currency, but they're not. They're not part of tier 1 or tier 2. They are a virtual asset. And of course, since last year, when we went into this virtual economy, it just makes sense that along with it, we should have some kind of a virtual asset as a form of payment, but it is not a currency. It's a form of payment. It's an asset, as I said, a virtual asset of exchange. And that's because people are desperately looking for an alternative to the US dollar. It is pretty clear that, unfortunately, the economy currently is in dire need of this liquidity, this stimulus. It will have longer-term implications, not only for the US dollar, but for us, for the economy. Because what's coming here is that not only we're going to pay through all this stimulus with potentially what appears to be is price inflation, although we have seen asset inflation. If you take a look at virtual art that was sold for $62 million, collectibles, diamonds, cars, vintage cars, all of those have exploded. The stock market, those are asset. That's what is called asset inflation. That's where the inflation went. The money that was put into the system, that went into corporations, executives to buy back their own stock. People, pretty much didn't need the money, were able to, put it back in the market at literally no risk, no cost, and make a fortune. And so it has created a tremendous disparity in the wealth gap. And we're beginning to see, again, a lot of repercussions, a lot of resistance coming back. And it's showing in the form of populism. It's showing in the form of Reddit. Millennials are aware of what's going on, and I believe it's a force to be dealt with. And I think trading in this market, futures markets or cash market, gives you the ability, at least for you to be able to protect the integrity of the purchasing power of the currency that you're dealing with. And in this case, buy in metals, buy in gold, buy in silver is converting fiat currency to money assets. Silver is real money. It's always been real money for thousands of years, and it will continue to be. And I think people are beginning to look at, the fact that silver is the most undervalued asset across the board. So if you look at money as a commodity, money is on sale. Money is on sale in silver, and that's what people are beginning to recognize. Real money, silver, is on sale for $26, $27 an ounce. It's going to take a little time for people to begin to realize what that means. And until we see, something of a significant nature in the markets occur, or, people will, certainly will miss the boat. And I think that this Reddit crowd, what it has done is it has brought attention to this real, I think, opportunity that we're looking at. I think it's a historic opportunity. I continue to say that in order for you to be able to balance and protect the integrity of the purchasing currency that you're trading in, trading gold is, or silver, even as a percentage of your portfolio, is not a bad idea under the current environment that we're in economically. Politically, well, we saw what happened and here we are dealing with the consequences of all of that in the pandemic. $17.35.70. Some buying coming into the gold market here. Stay long. Be patient. Stay long. It's going to be a very strong day if we are able to turn to the plus here in this market. In the gold market, I think is going to lead the way to all the other derivatives that are beginning to turn positive. It's been a pretty quiet morning on the derivative side. Another green bar. You can see buyers taking out the supply here. The target is 1739. Just continue to hold. $6.50 traded. We're taking a look at GBTC here. Right into the resistance levels here. So 51,220. Yeah. So we want to watch this carefully because this is a trading instrument once again, and it's a great trading instrument. So let's see how this resistance building up here is able to resolve itself. Looking actually for the short side on GBT. We've recommended our traders here to go neutral on GBTC for the time being. Very quiet and mixed in the derivative markets here. This is the daily chart in gold, and it might look real busy to you here, but I have quite a bit of data in here, monthly, daily, weekly. And you can see the market today here. It's come down to this Fibonacci trend lines as well that coincide with the buy one levels of 1732 and the weekly 1722 level that we did not quite come down to it. The harmonic alignment on the extreme below the mean is in that 1720 to 1722. And on the daily, you can see it at 1739, 1738. So we're moving towards our target, 1738, 1739. So continue to trail your stop as the market moves up if you are holding on to the target. This way, again, you are locking in any profit that you may trail below. The silver is kicked in, a buy trigger here, and it seems to be getting big bars behind it. So the volatility could be really huge coming up here. Silver market is activating a buy trigger. We're trading at 25.81, 25.81.50, 25.75 is the trigger point. So we're about 6 cents away from it. It depends upon the risk that you want to take, but it is activating a buy trigger. We are long. Well, we're holding long positions. We recommended our traders in my private trading room to hold the long side of the market and to trail it with a stop, hold derivatives long as a swing trade, and hold a core position long as it appears the market's path of least resistance is beginning to move up to the upside. 25.85 above is another buy trigger for silver. 26.04 are the targets for the daily signals. So we're getting daily and weekly signals activating buy triggers here in gold and silver. The 10-year note is trading at 168.80, down about 0.44%, down 2.57%. So it's reverting back down, and I think it's helping the metals and the rest of the markets as well. This confirms what I said to you earlier with regards to interest rates, and I think the 10-year note somehow is correcting from this anomaly that we saw, and it's taken some of the pressure off, you might say, from interest rates rising for the time being. So my friends, continue to hold alongside in the metals here, gold and silver. Trade, buy on corrections, and trade from the long side. this is going to be an interesting week here once again as we get the March contract expiring or going off the board. So let's take a look at towards the end of the week here what the end result looks like here for that contract. Thank you, everybody, once again for the opportunity to share this truly incredible intelligence with you. And if you have any questions, reach out to us here. We're here to assist you. And hopefully every day that you come here, you're becoming a better trader. You take care of yourself. We'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.